Good afternoon. Well, South Africa's third largest bank by market value, of course, reported an 84% rise in headline earnings per share, active clients growing 14%, and the group declaring a final dividend of 24.40 per share. To talk to us and create some color in terms of the year that was for Capitec, we are joined by Gerrie Fourie, who is the CEO of the bank. Gerrie, thank you so much for your time. Some very good numbers here. Let's talk about the key drivers for the past year.
Yeah, I think key drivers is for sure the credit side. We had very strong credit performance. That's also reflecting in our provisioning figures. And then on the insurance side, both on credit and on funeral, very strong numbers. And I think then on a transactional side, if you look at 4.5 million clients that's joined us over the last 2 years, or another 2 million clients that's joined us, and our transactional income up 23%. So, yeah, I think it's not one particular product or one particular item. I think overall it's just a strong set of results.
Let's focus a little bit on the credit side. I can imagine you get a lot of data, especially when you look at the way in which your clients engage with the bank. What sort of trends are you seeing from a credit space point of view?
Yeah, I think if we look at our career space, we've seen a big change to higher income earners, people earning more than 15,000 Rand. That's your net inflow after tax and deductions. We've seen that 52% of our capital that we advance is to people earning more than 15,000 Rand. And then if I look at cash stress, that's probably the biggest indicator for us is what we do is we look at our people that salaries are coming in, and then after the salaries and all electronic deductions, all the debit orders, etc., what if they got less than 20% left over, then we believe they're under stress. And we're seeing a big improvement on that side, especially in the hospitality and retail side. Those two sectors have performed well.
The one aspect a lot of CEOs have been debating, especially going into 2022, was trying to imagine, or rather a post-COVID world, especially when we deal with a hybrid working model. What is the view and the strategy for Capitec, especially when it regards to your employees, your branch employees, in terms of how you navigate this new working world?
Well, we have taken on a completely flexible working model, so we believe people should be at office a certain amount of time. It should be a combination of working from home, working from office. But if you want to develop people, you want to grow people, you want to shoulder to shoulder develop people, you want to build a culture, you need to be in the office. And then if you've got certain jobs like programming, etc., that you want to perform, you can work from home. I think what is also important is the flexibility. We've now created the capability of our branches not only performing branch work, but also doing call center work or helping in other areas in the bank. So we've created flexibility right through the organization to be able to assist where there's pressures, and that creates new job opportunities and multi-skilling opportunities for our staff.
Which is a nice entry point to my next question then, which is how do you continuously get to, I suppose, drive clients into your digital platforms? What are some of the strategies on that front?
Well, I think it's a combination. It's a combination of selling digital on branch level, making certain that people are comfortable on the digital platforms. And then what is very important is once they've adopted digital is that to engage with the client on a continuous basis. We've sent out in last year 275 million SMSs, communications to clients on what is the best way to bank, what is the best way to transact, what is the best products. So it's a continuous process to make certain that clients understand digital and adopt digital. And we've got 10 million clients that is on a digital platform. So I think we've been extremely successful in that regard.
Before I let you go, what will you and the team be focusing on?
I think digital for sure. And then on the payment side, I think one needs to make payments much easier. So the whole QR payments by card, moving people away from cash would be a big focus areas for next year. And then I think, developing and making certain that we can deliver exactly what we've done in retail, we can do on the business banking side. We believe there's plenty of opportunities, and that will be a big focus area for next year.
Gerrie, thank you so much for your time. That is Gerrie Fourie, who is the CEO of Capitec, taking us through the company's financial performance. As we now look at what is happening from a markets point of view, we did see the Asian performance giving us a bit of a mixed picture. And this is as investors continue to assess the situation on the ground when it comes to the lockdown measures regarding China. The one aspect that has been, of course, a topic for a lot of the investors this morning has been the performance of the Japanese yen. So now the reason the yen this morning has taken the most, I suppose, call it the brunt of the pressure coming in has been because of the central bank, the Bank of Japan's stance when it comes to going into the easing policy. They've committed to a monetary policy that is fairly easy compared to what we've seen with other central banks, especially as we move into a higher rate cycle environment. What we've seen with the Japanese yen, which has a lot of investors on edge, is that rise of around 125.77. It's the highest since August 2017. Rather August 2015. And that has actually prompted some of the behaviors that we have seen in terms of a financial point of view from a market picture. But then the other key consideration that will definitely have markets talking is the US CPI inflation numbers that we are expecting at around 2:30 this afternoon, which would be 8:30 Eastern time in the United States. To give us a picture in terms of market expectation, but also to talk us through some of the developments we are seeing, we are joined by Martin Smith from Anchor Capital. Martin, thank you so much for your time. Very interesting performance, especially as we look at what's happening from an Asian point of view and how that's filtering through to Europe, and also what's happening on our local bourse. What's your sense of the JSE's performance right now?
So, the JSE has been incredibly resilient. The kind of backdrop that we've seen globally, we're up about 5% odd for the year, while global markets are down, call it in the region of 10. And you've also had a strengthening of the rand from 16 to now about 14.55. So South Africa, the JSE and the rand have all been very, very resilient given this backdrop that we've experienced, largely in the back of what commodity prices have been doing and obviously how that's kind of filtered through into our market, into our currency. Today, though, we're getting caught up in a bit of the risk-off sentiment that we're seeing. I think people are starting to fear a US recession. I think that's kind of a bit of a fear in the back of investors' minds at the moment, and we're definitely getting caught up in the kind of sell-off that we're seeing globally at the moment today.
You may have caught a little bit of that interview that we had with Gerrie Fourie, Capitec publishing their financials this morning. I'm sure you may have had a chance as well to look through those particular figures. Any standouts for you?
No, well, I think it's to be expected from this great South African growth story. A lot of good momentum coming through, and our banks in general have been very well positioned post-COVID. They provisioned well during COVID. That's unwinding now. Also going forward, you've got a rising interest rates environment, which is obviously very beneficial for banks. And Capitec just seemed to keep putting the numbers on the board. The only thing that comes to with Capitec is valuation. That's always been the big driver of it, or kind of the investment thesis. And it's probably as full as it's been ever right now in terms of valuation. So looking a tad bit expensive, we've lightened our exposure across our business over the last month or two, but we still hold it. Again, great growth story, keeps putting the runs on the boards as we witnessed today, but valuation is always a little bit in the back of the mind.
I did mention in my intro that we are expecting US CPI numbers at around 2:30 this afternoon. And a lot of the expectations is that the figure that we get out of there could foreshadow more aggressive policy views from the Fed. What are the expectations here for CPI?
Yeah, so it's going to be higher than what we had in the previous number, which was a 40-year record, or the highest been in 40 years. So I think we expect around 8.5%, probably driven at the headline level, which will be fuel and food, obviously given what's happening in Europe. So again, it's a lot of concern around inflation and how does this impact interest rates going forward. I mean, we already got the Fed minutes out a week and a half ago, where we're now looking for a 50 basis point hike. So again, the rhetoric with global markets at the moment is what's happening with inflation, what's happening with interest, and how that'll filter through in interest rates. So people are going to watch this very carefully. And I think the thing to look for is not necessarily the headline number, but what's happening at the core inflation number, which is your goods and services, and are those starting to be more transitory, like people are hoping, and are they starting to normalize? So a lot riding on what inflation does over the next 3 to 6 months.
The one also, I suppose, key topic has been the rising yields. And I suppose the fear from those who are watching those yields is that as we start to see that rising yields, investors might be forced to go into, I suppose, call it the bond space. The question then becomes what happens from an equity point of view, especially if you're somebody who's looking or to find some value.
Yeah, so absolutely, your point's well made. And I think bonds find themselves in a bit of a tricky environment now, because bonds traditionally don't do very well in rising interest rate environments, but at the same time, they're also safe haven assets, which is kind of the environment we find ourselves in now. But looking at the bonds at the moment offshore, we think a lot of it's priced in insofar as their yields, and they've probably plateaued. And the same can be said of equities. I think a lot of the price movements are already in the prices that we're seeing. Investors obviously forward-looking, markets obviously always forward-looking. So I think at where we're at now, I think yields in bonds globally are kind of plateaued and kind of priced in. And I think the move from bonds to equities has already kind of transpired. Like I said, I think it's been priced in already.
Right. Before I let you go, one key event that you're going to be paying attention to for the rest of the short week outside of inflation.
I mean, we've got US earnings season starting, and that always traditionally starts by financials and the banks, JP Morgan and the like. And I think it's the last kind of base effect year where we had lockdowns in January last year. So I think it's the last time that we're going to have something coming off a low base, and then it's going to start to normalize. We're looking for around 15% kind of growth across the board. But again, I think the big thing again is going to be what does inflation look like? How is it affecting margins? And just a bit of a better picture on the US economy and how that's looking.
All right, Martin, thank you so much for your time. That is Martin Smith, who's a portfolio manager at Anchor Capital, giving us his perspective on the markets. We're going to take a quick break. When we come back, we'll speak to the CEO of PPS.